Hi guys, thanks for tuning in to another episode of Nuggets News. Well, today I'm going to talk about the speech that Governor Philip Lowe gave last night about unconventional monetary policy and lessons we can learn from overseas. So this is extremely relevant to Australia. It gives you some insight into what they're thinking at the Reserve Bank, and it's also important for anyone in any country with a central bank that's currently in easing mode, because some of the things he said are pretty revealing. And to be honest, I quite like Philip. He seems like a fairly an honest guy compared to a lot of other central bankers around the world. But it does remind me of Jerome Powell in the US, where I really liked him to begin with. And I said, I think this guy's a little bit more open and honest about what's going on. And then as soon as things got bad, he absolutely flip-flopped and went from raising rates and talking about unwinding the balance sheet to cutting interest rates and starting this QE of sorts in the repo market that we're currently seeing. So I've got some notes here. Don't mind if I look down from time to time, but let's get into it and talk about his address and then the questions that he got asked from a room full of businessmen, economists, and a few everyday citizens as well. So the gist of the speech was low interest rates are here to stay, and a lot of people are now starting to question monetary policy, which is fair enough. This has been going on for over 10 years since the financial crisis, and people argue whether it saved us from something really nasty or, if we are worse off and we haven't seen the last of it yet, we might be celebrating too early. US Fed Chair Ben Bernanke wrote a book about the courage to act, and I think he's doing his victory lap way too early. So the next step is more of this unconventional monetary policy rather than just the cutting interest rates and whatnot. There's now talk of QE, negative interest rates, all these other funky things that they're going to have to try, maybe modern monetary theory, buying real assets and stocks like we've seen in other countries in Japan. So this is unconventional monetary policy as it's known. And even in the countries where this has already been implemented, it's not really working. So he's talking about this lower bound in terms of dropping interest rates when it actually starts to do more harm than good. And a lot of people, particularly retirees and savers, are being hurt. So they're actually starting to knuckle down more and save more because the interest they're getting is less. And the opposite is what they're trying to achieve. They want people to go out and spend that money because there's no reward for saving. So this is one of the big problems I have with the whole thing, that central banks and governments have just decided that savers should be penalised and more debt is the answer. And I just don't agree with that at all. So the next thing he spoke about was over in the US and the different types of operations they can do. So I already spoke about interest rates, and they're now negative in some countries. And these liquidity operations, they're calling them. So the repo markets, overnight lending, some longer term stuff, but it's not a form of QE where they've said we're going to buy 40 billion each month or anything yet. So it's a bit of a grey area, but it very much is a form of QE or easy monetary policy. Their balance sheet is increasing again before they've even unwound it. So the next thing is now private assets. Should we go out there and buy corporate bonds off businesses? Should we go out there and buy stocks, and mortgages and this type of thing? So that's the big question now. This is where it gets to the friction, where people aren't happy and they believe that drives further inequality, and that's kind of a boundary that they're rubbing up against in terms of what they can do. And the final tool is forward guidance. So this is a really important one. This is literally the jawboning, the talking. So all these different Fed governors, every week they're out there in the US talking and just giving, they say it's confidence, and they want to let people know that rates are going to be lower for longer, and what they're doing, they want to be very clear rather than secretive. But it's propaganda. It's just talking it up. And none of these Fed economists have ever predicted a recession or said that things are going to get bad. They're always saying it's going to get better next year, or it's not too bad, we're pretty comfortable, blah, blah, blah. So I think it's important when we hear about that forward guidance and we talk about that to remember that less than a year ago, when we were making our documentary about this financial crisis, housing being overvalued, household debt, all these weaknesses structurally in our economy, that the RBA were talking about raising rates and how great everything is, and we're going to start growing again soon. So their track record for hitting their inflation target of trying to get that 2 to 3%, as well as predicting rate rises and cuts and everything, their track record is just hopeless. I feel like the weatherman does a better job sometimes, and when it rains, he says, "Oh well, no one could have seen that coming." So emergency policies, this is where he's talking about. These are highly unlikely in Australia, but at the moment, he is leaning towards the fact that he agrees. He thinks they worked to stop that financial crisis from turning into a Great Depression or a complete financial system collapse, that type of thing. So he believes that it was actually the right thing to do. But now that there's this talk about unwinding the balance sheet and getting back to normal, he's starting to say, well, when? And it's actually an if they ever can unwind their balance sheet and reverse what they've done. What they promised was emergency and short term, and it really is unproven, as I touched on before. Now, this leads us into what is beginning to happen, because this is becoming a long-term play, and it is very clearly hurting banks. I've spoken about this a lot on the channel, and more so in Europe, where interest rates are negative and they're really hesitant to pass that on to savers. It squeezes their margins. They're running out of capital. You guys know about all those structural risks. So one of the things that he's quite questioning, I guess, is the fact that asset prices have gone up, stocks, bonds, even real estate to a degree, but growth is pretty low, and stability, the risk of what's going on with banks and politically and whatnot. So this is what's, I guess, rocking the apple cart at the moment. And there's a big divide between fiscal policy and monetary policy, and it's starting to blur the lines, particularly who's in power and if they're going to give the government more money, and why aren't the government doing more to stimulate, and the government are reluctant to spend more money. So it's a bit of this blame game, which I've touched on again before, particularly in Australia where we're running a surplus. I just don't really see the point of printing money and giving it to the government to spend when they've already got money to spend if they've got a surplus. And again, people are not going to appreciate this. We're starting to see civil unrest when there's talk of this kind of thing happening, and that's really something that they didn't see coming. So there's this big perception of the rise in inequality, was one of his messages, but I don't think it's just a perception. I think it's actually a reality. That's what the numbers are clearly showing. Other central banks and the IMF have admitted this now. So having said all that, he's saying that, look, jobs growth, wage growth, it's all okay, and monetary policy can't really drive that growth long term. So again, it's that kind of passing of the buck, where are they in charge, the masters that they claim to be, versus the real economy and natural business forces and cycles and what the government are doing. So he's, I guess, summation was that the Aussie banks are really okay at the moment. There's no need for repo market operations, QE, or negative interest rates. But if things really change in future, then he went on to talk about what they could do. But at the moment, he thinks that Australia is far better off than a lot of the other countries. And this is where it gets interesting, because he's been very critical of all this unconventional stuff that they've got no choice but to double down on overseas, or to they're already there, whereas he's saying hopefully we don't have to do this in Australia, and he's criticising what's already happening in a lot of other countries around the world. So at the moment, he's saying, look, growth in Australia is okay, government debt is not too bad at all, and demographics are a lot better than a number of other countries. So maybe Australia does become the cleanest dirty shirt in the laundry, which is the US at the moment. So who knows what happens down the line. I think we've got a number of headwinds we're facing, so let's not get too excited, but there are a lot of other countries that are in far worse shape in terms of the government debt to GDP. Now in Australia, it's that private debt, the households, that's probably the main worry here. So yep, the negative interest rates, they're hurting banks and savers, particularly pension funds with those demographics of retirees that rely on those high rates of return, and really the confidence of cutting these interest rates and people picking up the paper and reading about negative interest rates. Everything that's happening in the Australian banking system at the moment is a bit of a joke after a Royal Commission, and I think that just erodes confidence in our financial system and our political leaders, a bit of a combination of things at the moment. So despite all this, they believe that interest rate cuts have worked here so far. So they've done 3 cuts recently, and it has managed to drive down the Aussie dollar. That has helped our exports, which we're very reliant on, and it's increased asset prices. Look at how sharply, Aussie home prices have risen, and I'm going to get to why that's really important in just a second. So in terms of QE, if it does happen, if things do get bad in Australia, what would they do? So no private sector assets at this stage. He doesn't think that is likely at all. So they'll be more likely to buy more government bonds, longer dated bonds, keep interest rates as low as they can. Possibly mortgages, mortgage-backed securities. But again, I think they're sort of tinkering at the edges here, and he wants a basket of different policies rather than just one thing, and highlighting that he doesn't think that putting all your eggs in one basket approach has worked out well in other countries. At this stage, you're talking about significant intervention in the private markets by the government, and that is what he wants to avoid when he's talking about not buying those private sector debts. And you're really deciding the resource allocation. Where do the resources go? Why do you get to decide? The Swiss National Bank is buying shares in Apple and the Japanese bank are buying ETFs. Why do they get to decide the allocation of capital and resources? And I'm going to tie this all together at the end, but it just doesn't really make sense why you're prioritizing and playing favorites with the big boys in particular. So definitely the first port of call is buying those bonds and reinforcing their commitment to keep rates lower for longer, to try and drive household and business confidence and maintain their credibility, which I already think is being eroded, as I highlighted before. So he doesn't see interest rates going negative in Australia. He must have said this at least half a dozen times throughout the speech. So 0.25% is as low as he sees interest rates going because they operate in a bit of a band, a target range. So once you hit that band, the lower part of that band is effectively zero already. So he doesn't want to have to take interest rates lower than that. He thinks that's when you really start to hurt, but the savers and the sentiment and whatnot, and that is where he's really going against what is already happening in Europe. So at that stage, which is only 2 interest rate cuts away now, and the market's already pricing another interest rate cut at least in the next few months. So we are so close that it's not funny to this, and then QE would start in a stressed market. But again, he's saying, I don't think any of this is likely. So the next question that he got, the first question that he got once we're into question time was, would you buy state government bonds as well? So they not just want to fund the government and help them out, actually individual states, which is really interesting. And again, he's sort of saying we haven't thought about this too much, possibly if things got bad enough, and even buying mortgages if there was dysfunction in the system, and he thought that would help the banks. And whatever is best for the people. So let's not forget that their mandate is full employment, prosperity of the Australian people, getting that unemployment rate as low as possible, and it already is pretty low, but they want to get it lower. So with 3 cuts, we have seen house prices rise, and this was the next question, and he basically responded by saying, no, I don't think it is our fault or those 3 rate cuts that have forced house prices to rise so aggressively. So the government getting re-elected and a few other things, bank lending and the Royal Commission being behind us. So he wasn't really worried about that at all because they're not seeing, credit growth and people getting, really aggressive back into more debt to go into that mortgage market and speculate again. So I kind of have to ask, well, when would you worry? Because household debt is going up. We just crossed over 200% household debt to GDP. So, just last week, the Deputy Governor actually said that monetary policy is still working really well in Australia because they've cut rates and it's caused asset prices to rise, such as houses. So that was really going against. One is saying one thing and the other going against it. So there was a lot of these, I guess, things where he was really contradicting himself. Now, the next question was from Matt Barry, who I'm trying to get on the channel. So if you've got a connection to him, please let him know that I want to get him on the show because he's done some fantastic work about what's going on in the Australian economy. He interviewed Malcolm Turnbull the other day, which I shared. So with interest rates so low, the IMF have spoken about how to make deeply negative interest rates work. And in a recession, you have to do those, the big rate cuts. We're talking 5 or 6%. So we're already at zero. What happens when we go to, say, minus 4%, and Australia's had this 27-year run without a recession. So every day we edge closer to a recession. And what do you do at that stage when you're saying that you don't want to go negative and you don't think QE is likely, but we're teetering on the edge here? And I actually think it's far more likely than he's giving it credence to. And this is why they're doing things like this cash ban. And Matt highlighted this. So it was really great to hear that. And again, he basically just downplayed it and says that he doesn't agree. He thinks that things are going pretty well here. We're at full employment. We've got okay inflation. And even though there's no wage growth, his people are still doing okay. And he actually said that he thinks wage growth is going to pick up to 3.5% in the next year or two. So I don't know where you get these numbers from. And if you look at the charts, every year, the RBA and all central banks say things will get better next year. We're going to go back to 2 or 3% wage growth. It's going to be really good. Now, I'm also working on a video which I'll upload soon about how CPI and inflation is massively misstated. So they're saying inflation is low, but the cost of living and the way they measure it and everything else is going up. So you're falling further and further behind. And that whiteboard video, I think you guys are going to really enjoy that, because it speaks about exactly what they're saying. Say one thing, but what's actually happening is completely different. And I think that's why people generally just aren't happy and why it doesn't feel that good, because they are falling behind, and underemployment is the big issue. So in the US, unemployment is at record lows. In Europe, in Australia, the amount of labour force participation, all these things are at record highs, but everyone feels like they're falling behind. So when things are so good and there's only room for things to get worse, that is what worries me. And we've already started to see unemployment tick up slightly in Australia, and we're not really having the good job, the full-time jobs created. So tying it all together, the next question was about QE. Did it work or not? Look what happened in the US, Europe, and Japan. Japan have been doing it for decades now. It's caused these huge financial distortions and risk. And a lot of their models actually don't work when you plug in a negative number. So QE is an issue. This was his answer. QE is an issue when asset prices rise and we don't get growth. Well, I'd argue that that's kind of what's happening. The share buybacks, all these fudged non-GAAP accounting, misreported inflation, that we don't get any growth, and it has dramatically increased asset prices. So I think this is happening. I don't agree with him saying that, it's only an issue when that happens. It's already here. Why doesn't it feel good? I just spoke about that. I think we see that in business confidence and talking to people on the street. More people watching my videos and other people in Australia that are talking about this. People are very aware of these issues. It's all over the media what the banks and that are doing. So tying this all together, I think his take-home message was the only way around this is a combination of things, and we need business to invest. We need creative jobs, innovation, technology, all those things Malcolm Turnbull spoke about in that speech recently. And we're not really heading towards any of that in Australia. We're playing around with the edges. We've brought forward a little bit of infrastructure spending. We've got this aged care package. But really, if you look at the numbers, these are really, really tiny compared to what we would need to have a huge injection and encourage business startups and get wage growth and attract high-paying, high-skilled jobs to Australia when you look at the cost of living. And I just don't think we are creating the conditions for business to invest by giving banks more money, buying mortgages and buying stocks, talking about how great things are. Look at all those tools in their toolkit. None of it leads to innovation and making the economy a completely structurally different kettle of fish. So that is what worries me a little bit. I hate saying that as an Australian, but it does apply to all countries and what's going on with central banks at the moment. What do you guys think? I'm looking forward to reading all your comments below. I'm actually still pretty positive on a lot of areas in Australia. People say, oh, you're a housing bear. Well, I've got a couple of properties down in Tasmania, but the cost of housing compared to wages there is in the 2s or 3s, that ratio. In Sydney and Melbourne, it's 10 or 12, times your income to buy a property. So I don't think it's, in a bubble by any means down here, and property has done fairly well. So there's areas of good and bad in anything, stocks, property. But yeah, the way that everyone is piling into these bonds at the moment and talk of modern monetary theory, which is the last thing that I haven't really tried yet, and people's QE, where who knows what government's going to do in terms of that spending, and then we do get inflation. They finally get that inflation that they're after. But with everyone in so much debt, when central banks are forced to raise interest rates with household debt, credit card debt, auto loan debt, that is when the economy can actually, really get messy. So let me know what you guys think below. I hope you appreciate that summary of Philip Lowe's speech. I would love to have him on the channel. I don't want to, stand here and bag him. I think he's an intelligent guy. So I want to put these questions to him because I don't think central bankers get asked the tough questions enough in these press conferences. So hit that like button, subscribe if you haven't already. Please share this with friends and family, and I'll talk to you again soon. Cheers.